Buffett's $200 billion is sitting idle. Profits have collapsed. Berkshire Hathaway just posted a 30% drop, its worst earnings miss in years. The market is rattled. Investors are watching the cash pile grow quarter after quarter. No one is buying. No one is selling. The world's most famous investor is refusing to deploy capital. Power is slipping. Buffett, once the ultimate allocator, now looks paralyzed. Wall Street is asking, what does Warren Buffett see that no one else does? Control is breaking. Confidence is draining away. The signal is unmistakable. Something fundamental has shifted. But the real shock isn't the profit plunge, it's the silence. Berkshire's cash reserves are now larger than the GDP of most countries. That money is supposed to be working. Instead, it's frozen. The board is under pressure. Shareholders are restless. The market is searching for answers. But the only message is inaction. This isn't just caution, it's paralysis at the top of American capitalism. The longer the cash sits, the louder the questions become. Every quarter without action is a new vote of no confidence in the market or in Berkshire's own ability to navigate it. Berkshire Hathaway is not a typical company. It's a $900 billion fortress built on decades of disciplined capital allocation. Buffett's reputation is inseparable from the idea that cash should never sit idle. For years, every dollar was a weapon, deployed into railroads, insurance, energy, and blue-chip stocks. Now, that discipline has become a constraint. The cash pile is a monument to uncertainty. Berkshire's size, once its greatest advantage, now limits its options. The company cannot simply buy small or mid-sized businesses. Only the largest deals matter, and those are increasingly rare or unacceptably risky. The mechanism is clear. Berkshire's entire model depends on finding large, undervalued assets. The firm's scale is both its strength and its trap. With $200 billion in cash, only the biggest deals move the needle. But the market is expensive, private equity is aggressive, interest rates are high. Every potential target is either overpriced or structurally risky. Earlier this year, Berkshire was outbid by a consortium of private equity firms for a major industrial acquisition, one that would have fit its portfolio a decade ago. The deal went to a competitor, willing to pay more and move faster. The result, Buffett can't buy, but he also can't shrink the cash pile without lowering returns. The machine is jammed. The opportunity set has narrowed to almost nothing. Deploying capital at scale without sacrificing standards has become nearly impossible. Even the most disciplined investor cannot manufacture value when none exists. This is not a temporary pause, it's a structural gridlock. Berkshire's investment criteria are strict by design. The company avoids tech speculation, refuses to overpay, and demands durable moats. But the modern market is dominated by growth stocks and private capital. The old playbook doesn't fit. Every quarter, the cash grows. Every quarter, the pressure mounts. The board faces a narrowing set of options, lower standards and risk permanent capital loss, or keep waiting and risk irrelevance. There is no middle ground. The discipline that once protected Berkshire now threatens to isolate it. The company is caught between the risk of action and the risk of inaction with no clear path forward. The inflection point came with the latest earnings. Profits fell 30%. The market expected a miss, but not this magnitude. For the first time, analysts questioned whether Berkshire's conservatism is now a liability. The cash pile, once a symbol of discipline, is now a warning sign. Shareholders are asking if the company has become too cautious to compete. The board is split. Some want to return capital to investors. Others argue that patience is the only defense against a frothy market. There is no consensus. The debate is public. At the annual meeting, a prominent shareholder openly challenged the board, demanding a clear plan for the cash. The exchange was tense, and the room was silent. Every statement from the board is scrutinized for hints of a shift in strategy. The risk is that indecision itself becomes the story, eroding confidence further. What this exposes is a deeper contradiction at the heart of modern capital allocation. Scale creates power, but it also creates inertia. Berkshire's size means it can't act nimbly. Every decision is a signal to the market. Every hesitation is amplified. The firm's legendary discipline now looks like indecision. The market is watching for any sign of movement, but the only message is stasis. The larger the cash pile grows, the more it signals that opportunities are scarce. or that Berkshire is no longer able to seize them. The company's strength has become its weakness. This matters far beyond Berkshire. The company is a bellwether for institutional risk appetite. When Buffett hoards cash, other investors take notice. It signals that the world's most patient capital is unwilling to play. That ripples through markets. It tightens liquidity. It raises questions about asset valuations everywhere. If Berkshire can't find value, who can? The message is clear. The market may be more fragile than it appears. When the most disciplined capital refuses to engage, it forces a reassessment of risk across the financial system. The lesson is uncomfortable. In a world awash with capital, even the best investors can become prisoners of their own scale. The mechanisms that built Berkshire's empire, discipline, patience, selectivity, are now the very forces that threaten its relevance. The market is not waiting. Capital that sits idle is capital that loses power. The longer Berkshire waits, the more its influence erodes. The market's memory is short. Patience, once a virtue, now looks like hesitation. The closing insight is stark. There is no easy fix. Berkshire's cash pile is both a shield and a warning. The world's most famous investor is signaling that the game has changed. When discipline becomes paralysis, even giants can stumble. CapitalRifts, where money breaks,